So I just set the background once again. What we are doing is we are trying to do valuation. So to understand the concept of valuation, suppose you are an analyst and you are thinking what is the value I should attach to the target. So you could be attaching, let's say, you could be representing the acquirer also. You could be representing the target company. That means the company that you are proposing to acquire. And you will have a forecasting period. So you will normally forecast the cash flows up to a particular period. The question is, why do you need to do that? So today you want to buy any asset. Forget about a firm. Even if you want to buy a laptop or a MacBook or a phone, you think na कि भाई मेरे को the benefit that I am getting should be more than the cost that I am willing to pay. Sometimes you might be able to objectively quantify it. Sometimes you may not be able to objectively quantify it. But that's the crux behind the whole problem, isn't it? So same way, if you're acquiring stakes in a business, you want to buy out a business, you will forecast the benefits, which are the cash flows that the business is going to generate, and put a value to that. And you will not be willing to pay a price which is higher than that value. The price will be limited to that value that you are generating from that business. But आपकी दूरदर्शिता तो सीमित है. ज्यादा से ज्यादा आप 5 साल 7 साल तक फोरकास्ट कर सकते हो. उसके बाद करोगे भी तो it is not realistic. So what you are forecasting, that period, let's say forecasting for 5 years or 7 years, that is called as a forecasting period. But even if you acquire the stakes in the entity, your forecasting ability is ending after that 5-year period or 7-year period. But the company that you're acquiring is not going to die after those 5 or 7 years. So the valuation should be done for the forecasting period as well as the periods after or beyond the forecasting period. And then the sum of the parts comes in, where the valuation of the enterprise value would be the sum of the benefits that you are forecasting within the forecasting period as well as beyond the forecasting period. That's the fundamental. And you will not be willing to pay a price which is more than that value. Now, how do you forecast? So what we do is, we first arrive at, I'm going to use FCFF as the model. We first arrive at FCFF, where FCFF stands for free cash flow to the firm. And the formula for FCFF is net income plus I into 1 minus TR plus NCC minus CapEx minus working capital investments. Now let's understand the formula first. Don't memorize it, just understand it. So NI stands for net income. Net income is the income that is available to the shareholders. Now, is net income the same as cash generated by the business? No, obviously not, because profit and cash are dissimilar. That's the whole reason why we prepare the cash flow statement also. So your P&L will have lot of non-cash adjustments. Example of a non-cash adjustment is depreciation. So depreciation is just a notional charge to the P&L to account for the wear and tear in the assets. So depreciation की वजह से क्या होगा? Your profits will come down. Have you ever seen depreciation hitting your bank statements? Never. So it just hits your P&L and reduces your profits, but it never touches your cash book or cash funds. So your cash is here and your P&L is here. So if you want to move from profit to cash, you need to add back the depreciation. Now the next question you will ask me, sir, if you want to add it back itself, why are we reducing it in the first place? Because depreciation is an allowable expense as per Income Tax Act. So you reduce depreciation, take the tax benefit, and then add back the depreciation to arrive at the cash flow. So that takes care of these two components, net income and NCC. NCC stands for non-cash charges. One example of a non-cash charge is depreciation. Then we also add back this I into 1 minus TR. What is I? I is your interest cost or your finance cost. Why do we add back I? First, look at I. Forget about 1 minus TR. Just look at I first. Because we are finding out the cash flows at EBIT level before the payment of interest. This is free cash flow to the firm. FCFF is free cash flow to the firm, to the entire firm. Now, who has provided capital to that firm? Equity shareholders, bond holders, debenture holders, everybody. So it's a combination of equity shareholders as well as the fixed capital providers. So you need to find out the free cash flow that is available to both of them. So that's why we add back the interest. कि भाई कितना cash बाकी है before we are paying to any of these. So that's why cash before payment of interest, before payment of dividends. That's why we add back I. Now, if you're adding back I is fine because FCFF is anyways an unlevered cash flow. Unlevered means you are nullifying the impact of leverage. Leverage stands for borrowing. So you're assuming as if the company has not borrowed anything. है कि नहीं? तो इसीलिए हम इंटरेस्ट को नलिफाई करते हैं, ऐड बैक करते हैं. बट द क्वेश्चन इज आई तो कर लिया, व्हाई आर वी डूइंग इनटू 1 माइनस टैक्स रेट? Interest, very much like depreciation, is tax deductible. That means you reduce interest. If your interest goes up, your PBT goes down. If your PBT goes down, your tax liability also goes down. Which means interest has the effect of reducing your taxes. So there is a tax benefit associated with interest. So then English में एक मुहावरा है ना, you can't apply butter on both sides of the bread, or you can't have the cake and eat it too. तो एक तरफ आप बोल रहे हो कि हमें इंटरेस्ट नलिफाई करना है, तो अगर आपको इंटरेस्ट का इफेक्ट नलिफाई करना है, उसके टैक्स बेनिफिट को भी आपको एलिमिनेट करना पड़ेगा. दैट्स व्हाई वी डू इनटू 1 माइनस टैक्स रेट. So that takes care of this component. Now what we are left with is only capex and working capital investment. Why are we reducing capital expenditure and working capital expenses? Why? Because this, suppose you are committing to buying a machine, or you're committing to buy, let's say, invest in a plant. This is going to cause a cash outflow, no, for the firm. So it will reduce the cash that is available for the stakeholders or for the firm. Similarly, any working capital investments that you're doing for any sanctioned projects, that is also going to cause a drain on the cash. So free cash नहीं होगा वो, because वो cash use होने वाला है. So to arrive at free cash flow to the firm, we reduce both capex and working capital investments. तो ये जो आपको यहाँ पे ये cash flows दिख रहे हैं, ये वाले, these are all future free cash flows. Now, can I sum up? Can I do a sigma of these cash flows to see the benefits? We can't. Because $100 cash flow after 1 year is not equivalent to $100 of cash flow today. $100 cash flow after 3 years is not equivalent to $100 today. So you need to convert these future cash flows to the present values. Once you have converted all these cash flows to the present values, you will now be able to add up all these cash flows to arrive at cash benefits. Clear? Because अब वो same time zone में आ गए. But this takes care of valuation only within the forecasting period. We have still not valued the business for cash generated beyond the forecasting period, for which at this point in time, TVN, we have to calculate what is called as the terminal value or terminal valuation. We need to terminal मतलब end में, at the end, for which we will apply what is called as the Gordon's constant growth model. Just for your knowledge, the Gordon's constant growth model says that P0 is equal to D1 by KE minus G. Now let's understand the crux behind the formula, the construct. Don't memorize. You'll understand why it is like that. So if let's say Praveen wants to invest in this share, he wants to see what is the price that he's willing to pay for a share. So he first forecast कि अगर मैं ये share में invest करता हूँ तो next year the company is going to pay me so much dividend. And these dividends we will assume are going to grow continually because now we are doing terminal valuation beyond the forecasting period. So we have to look at continuity and divide that by KE minus G. What is KE minus G? Your expected return. So it's Praveen's expected return from the investment. We reduce G to create the multiplier effect because you need to value the business for the entire period. So that value has to be much larger. So अगर आप फॉर्मूला को ठीक से देखोगे ऊपर क्या है रिटर्न नीचे क्या है Praveen's expected ROI. What is return by ROI? Investment value. ROI is return by investment. So what is return by ROI? Investment. So that is your price. But this is the price of a single security, a single equity share. Here we are not valuing the single security. We are valuing the entire firm. So this P0 will, to create the multiplier effect. I'll tell you when you see the Excel, you'll see. So rather than P0, we are actually doing TV5 here. So instead of P, we are doing TV. Instead of a single security, we are taking care of the entire firm's valuation, terminal valuation. Instead of 0.5, why? Because the forecasting period in this case or example is ending after 5 years. So we need to do the terminal valuation at the end of the forecasting period, which is TV5. अगर यहाँ पे 0 है तो यहाँ पे क्या आएगा 1 है. So अगर इधर 5 है तो it will be 6. But instead of dividends, we are going to take FCFF 6. Because we are extrapolating it to the entire firm. So FCFF 6 instead of KE. KE was the expected return for the shareholders. Instead of KE, we will do WACC. WACC stands for weighted average cost of capital. So you are taking return for all stakeholders, not only equity. So we have just modified the formula to extrapolate the effect of single share onto the entire business. Once we do this TV5, this is again terminal valuation at the end of the 5th year. Now we need to discount it also to the present and we will get PV of TV5. That means today's value of the terminal valuation. So now what have we got? We have got two parts. The present value of the benefits that the firm is expected to generate within the forecasting period and the present value of the terminal benefits that it is going to generate beyond the forecasting period. We sum it up and we arrive at the sigma will tell you what is called as EV, where EV stands for enterprise value. Are you getting my point? All of you? आया समझ में कि नहीं? So what we will do now is we are going to do an example to be able to explain this to you. Yes? Enterprise value is the total firm's valuation. Market cap is only equity valuation. So now what I'm going to do is I'm going to do an example for you right in front of you on the screen to show you how we do enterprise valuation. I'm just putting it as EV. EV stands for enterprise value. So what is the fundamental? Since this is BFM, it's business and financial modeling. So we need to be focused more on the Excel application. But the point is, you can't understand a thing, even 1% of this Excel application, if you don't understand the subject. That's why that explanation was a prerequisite for this funda. Okay. So now what I will do is I am going to put all these inputs here. So let's say I do a 1 year forecast for year one, just for year one. So let's say I have revenues forecasted for the year one and all figures in $1 million. So let's say the revenue is $100 million. Simple example, just to see how the enterprise value is calculated. Now let's assume that the valuation that we are doing is based on a forecasted gross profit margin of 60%. Gross profit margin is GPM. Let's say we are assuming that the gross profit margin is 60%. So if the gross profit margin is 60%, your COGS will be 40%, which will be now the crux of modeling is don't hard code. Always use linkages. So into 1 minus this number. तो ये इनपुट चेंज होगा ना, येलो में जो भी इनपुट है, if that changes, the model will change automatically. So you get your COGS, you get your GP, which is your gross profit, which is 100 minus 40, which is 60. Then we reduce the operating expenses without depreciation first. So let's say the operating expenses without depreciation is 20% of revenues. So I'll put here 25% or 25%, let's say. So 100 into 25%. So your OPEX is 25%. If you reduce that, you get EBITDA. What does EBITDA stand for? Earnings before interest, taxes, depreciation, and amortization, which in this case comes to 60 minus 25, which is 35. Now, assuming that this is an organization which is not very heavy on capital equipments, so maybe we can keep the depreciation as a fixed number. Let's keep it at 10. And this is 10, not 10%. This is just 10. Okay. So your depreciation has to remain constant, assuming a straight line method of depreciation. That is 10, you get EBIT. EBIT stands for operating income or operating profit, which is earnings before interest, taxes, earnings before interest and taxes, which in this case comes to 35 minus 10, 25. Now, every company has finance costs also. What is finance cost, by the way? Very good. Finance cost stands for interest. Now, assuming that the firm has a term loan and the term loan carries 8% interest, which works out to maybe $15 million every year. Or let's keep 5 because they don't have too much capital commitment, so interest would be lower. I'm just giving random numbers, no reason behind this. So you get PBT. PBT stands for profit before tax, which is 25 minus 5, which comes to 20. Now assume that this firm has a 40% tax rate. So if I keep a 40% tax rate here, taxes will be how much? 40% of PBT, which will be 20 into 40%, which is 8. So you get PAT, which is profit after tax, which is also called as net income. We don't have any preference dividends here, so we can keep this as net income. So 20 minus 8 is 12. Now assume that the firm has capex and working capital investments planned, maybe $10 million of capex and $2 million of working capital. These are also inputs, by the way. Huh? Anything changes, the model changes. So we are now ready to find out FCFF, free cash flow to the firm, which will be, if you look at the formula I explained, net income plus I, which is interest, into 1 minus tax rate, which is 1 minus 40%, plus non-cash charges, minus capex, minus working capital investments. You get your FCFF as $13 million. Now, let's assume that these cash flows have to grow by maybe 12.5% year on year for 5 years. We are keeping 5 years as the forecasting period. There are two ways of doing this actually. You can either grow all the numbers independently to arrive at free cash flows, or some analysts, what they do is they just grow the cash flows. So 13 into 1 plus 12.5% for every year. So I'm just growing these cash flows. So here 1, 2, 3, 4, and 5. So these are my cash flows. Simple. They're just application of that formula which I told you. FCFF and then grow it. Now we have to discount these cash flows to the present, for which we need weighted average cost of capital. Assume that the weighted average cost of capital is 11%. Assumption again, we can change these assumptions. So it will be 1 by 1 plus R raised to the power of n. You remember discounting factors? 1 by 1 plus R to the power of n. Yaad hai na? So that is this discounting factor. No. And 11% is your cost of capital. Correct. You're right. So 1 by 1 plus R, and then isko hum drag kar denge. These are your discounting factors. So now you will get your present value of free cash flows to the firm within the forecasting period, which will be future cash flows multiplied by your discounting factors. Discounting factors. Discount. You're discounting your future cash flows to the present. इसीलिए उसको डिस्काउंटिंग फैक्टर्स बोलते हैं. इसके बाद इसको आप ऐड कर देंगे. So with this one which I have highlighted in blue, what is this exactly? Not the entire valuation. No. That's the value I was looking for. Very good. It is the valuation of the benefits within the forecasting period. Now we need to do the valuation beyond the forecasting period also. So beyond forecasting period ke liye we will do TV5. TV5 stands for terminal valuation at the end of the forecasting period. In this case, it is 5th year, which will be FCFF 6 by WACC minus G. So FCFF 6 will be free cash flow to the 5th year. आपको पता है? You have to assume a perpetual growth rate. Now, perpetual growth rate can be very, very small, something like maybe 2.5%. Just an assumption. So TV5 will be FCFF 5 into 1 plus perpetual growth. Why? Because we need FCFF 6. इसीलिए divided by WACC minus G. WACC is 11% minus G is 2.5. So you get your terminal valuation, which is much larger. Do you see now, Ritik? It's because of the multiplier effect. The terminal valuation is much larger. So this becomes your terminal valuation. But we need to discount this also to the present value. So we need present value of the terminal value, which is how much? Just apply the terminal values to the discounting factor. है ना? 5वें साल के discounting factor से कर लो multiply. So you get this also. So now you have got both the parts, valuation of the benefits within the forecasting period and valuation of the benefits beyond the forecasting period. So your enterprise value is nothing but the summation of all these present values, which comes to $209.18, $209 million. समझ में आया? That's how you do valuation. Now you can create best case, worst case scenarios because any of these numbers change. कुछ भी change कर दो यहाँ पे आप. Let's say I change my gross profit to 40%. ये देखो, everything changes. This comes down. Can you see that? Suppose I reduce my OPEX to 15%. ये देखो, terminal valuation has gone up to 305. Everything will change on its own. That's the meaning of this yellow. The yellow stands for inputs. All of you okay? So now I'll create best case and worst case scenarios also for this. Using the scenario manager, I'll create two scenarios. One is called as best case, which is optimistic, where I will be changing the OPEX and free cash flow growth rate and terminal value growth rate. These three I will change. समझ में आया? So what is the first value? B13. B13 means what? OPEX था ना? So OPEX का current value is 25%. For best case, we will reduce the OPEX. What is your best case? Your operating expenses will reduce. So we bring it down to 20%. Then free cash flow growth rate. It was 12.5%. We'll make it up to 15%. Just random. And terminal growth rate, which is 2.5%, we will make it 3%. So this is your best case scenario. Similarly, we will also create a worst case scenario, which is the pessimistic scenario. Again, same three cells. So OPEX now will increase in the worst case. It will become 30%. Your free cash flow to the firm, we made it 15, we will make it 10% growth rate. And terminal growth rate, we made it 3, we will make it 2%. So now what we have done, we have created two scenarios, best case scenario and worst case scenario. And then I'm going to click on summary, on which I just need one summary, which is the enterprise value. And I press OK, and you will see that entire summary comes at a click of a button. And it tells you a range within which you are playing. So what is this? This is your OPEX percentage. This is your FCFF growth rate. And this is your terminal value growth rate. Isn't it? And it has given you the valuations for each. This is your base case, which you are well aware. ये हमारा base case था. Optimistic best case will give you a valuation of $291.27, $291 million. Worst case will give you a valuation of $142 million. So depending upon how, so it gives you a range, that depending upon one or many independent variables, if they change favorably or unfavorably, how will my terminal valuation or how will my enterprise value change? So your enterprise value can range between $143 million to $291 million with a base valuation of $209 million. Is it okay? So that was about valuation. Sorry? Yeah, you are right. This is EV. Correct. This is enterprise. Okay, that was the valuation bit from a modeling perspective.